Welcome to the podcast about venture capital, where investors and founders alike can learn how VCs make decisions and reach conviction. Your host is Nick Moran, and this is The Full Ratchet.
Drew Oetting joins us today from Austin, Texas. Drew is a founding partner of 8VC, a venture firm that has invested in companies such as Anduril, Asana, Blend, Oscar, and many, many others. In addition to investing at 8VC, Drew is also a serial founder, having co-founded both Affinity and Resilience. Drew, welcome to the show.
Thank you for having me.
You bet. So can you walk us through your background and your path to venture?
Yeah, well, I guess we share one thing in common, which is we're both originally from Iowa, which is a small but very proud crew of us in venture. So I grew up in Iowa, and I was obsessed with two things really from a young age. I was obsessed with golf, and I was obsessed with investing. And so when I thought about where I wanted to go for college, I had read this book, Barbarians at the Gate, which was the story of Henry Kravis and George Roberts, KKR, and really the LBO sort of private equity emergence as a big asset class. And they had attended this college, Claremont Men's College, now called Claremont McKenna College, in California. And I got a recruiting letter from their golf coach. And so I knew what it was, even though it's a really small school, and I'm from Iowa, go there. And so that's how I ended up at Claremont. When I was there, I studied math and econ, and I was always focused on investing. And I didn't really know what investing was. I thought it was sort of like day trading or private equity or hedge funds. But then over time, I had a set of experiences which kind of really led me to an interest in the entrepreneurial side of investing and being involved in startups and tech companies. One was I had a scholarship from a group called Cascade, which is the family office of Bill and Melinda Gates. A lot of Claremont people went there and worked there. And so I was very fortunate to have a scholarship through them and work with them and see venture capital and private equity. And then I also did the exact opposite, where I lived in Mongolia with a friend of mine, a guy named Miles Bird, who also works in venture now, and saw this crazy entrepreneurial guy who built this holding company, but he talked like an investor, but he also talked like an entrepreneur. And it was like crazy Wild West stuff. So it was very entrepreneurial. I was like, wow, I would love to kind of marry the two of these things. I don't really want to stay in Mongolia necessarily, but I do like the entrepreneurial aspects of it. So I knew I needed to get to kind of Palo Alto, which is the center of gravity for that world. The only job I could really get was in investment banking. And so I went to work for Moelis in their Palo Alto office. I was a terrible investment banking analyst, but I was very grateful that I got that job, and people I worked with there were amazing. But I basically started trying to recruit into startups or venture capital like immediately. And I was very fortunate to get introduced to my current long-term business partner, a guy named Joe Lonsdale. I got introduced to him through a friend of mine from Claremont McKenna, Clint Paulus, who really I owe a lot to for that. So that's how I got into it, really as a chief of staff. So, and it was when Joe was CEO of Adavar. So it wasn't even really yet that venture capital or investing, but we kind of knew that that's what we were going to focus on. And so I don't think it's a super traditional path in, but I actually don't think very many paths in venture are that traditional these days.
Yeah, very true. So I guess what ultimately led to the founding of 8VC? You met Joe. Joe is also one of your partners there. You guys founded the firm together. What led to the founding of 8VC? And would also be curious to hear the thesis behind the firm.
Yeah. So the founding of 8VC, it's kind of like multiple foundings. When I went to go work for Joe as his chief of staff, he was already underway building a venture capital firm called Formation 8 that he was building with two former partners of ours that he had known. And so the first two funds that we did were at Formation 8. And the thesis of Formation 8, one part of it is very similar to what we do today, which is investing in early stage companies focused on really the role of computation as it sort of infects many different industries. We can talk more about, that's a very high level thing, but we'll talk more about that later. But the other part of Formation 8's thesis was that we were going to help these companies go to market in Asia broadly. So we have business development offices there. And it was a very interesting thesis. It worked in certain cases, but the reality was it's actually a lot harder for a Series A or Series B company to do business in Asia. Like most can't even do business in the United States. So we just decided that for thematic reasons, but also just because I think we had different kind of views of the way we wanted to build a company, that we would kind of go our separate ways. So after two funds of Formation 8, we kind of broke apart the partnership, and it actually led to a bunch of different firms being founded. It led to iFly, which is Han Shen. It led to Eclipse, Leroy Susan and Seth and those guys, and a few others. But 8VC is sort of what, Joe and myself, and then a few other people that have been sort of advising us at 8VC went on to do. And we kind of took over the administration of all the Formation 8 funds and built 8VC up. And so 8VC was originally Formation 8. That was 2012. We started that. And then the refactoring from Formation 8 into 8VC kind of happened in 2016. So the first 8VC funds are 2016 vintages. But we view Formation 8 funds, which are 2012 and 2014, as are just as much ours as the other ones.
I see. What were the fundamental differences between you and the other partners that eventually broke away to do their own things? And the reason, to provide some context why I asked that, is because you're pretty unique at 8VC, and we'll get into some of those areas today. But I'm curious because it must be philosophical in nature to some extent, and I'd be curious to just hear you speak to some of those differences, and then we'll get into what you guys are doing and why it's so interesting in a moment.
So I think first was just the thematic thing I alluded to, which was that a big part of the infrastructure of Formation 8 was oriented around helping companies go to market in Asia. And when that was slower to develop, we had all these ambitious, talented people on the ground there, and what they started focusing on was doing investments. So all of a sudden, we had already deviated from the mandate. I don't mean that in a critical way necessarily, but it's just the way things happened. You have talented people on the ground. There's not business development opportunities. They're going to start looking at deals. So all of a sudden, we were shifting and sort of implicitly becoming almost like an international fund, where we had originally been trying to invest in Silicon Valley-based companies, which largely were driven by Joe's network, right? So Joe had been an intern at PayPal, co-founded Palantir and ran it, really built the engineering team there and sort of the organization there for many years, and then left and then started Adipar. He had a really strong network of people that, were leaving those companies, or he had met through those companies that were starting, many of the companies we talk about today. And that's what we wanted to focus on. We also wanted to focus early stage, seed, Series A, building companies from scratch, where we felt we had the biggest comparative advantage, not doing later stage deals, which many times that's what you had access to over there. Mm-hmm. So I think thematically, that was the first one. I think secondly was kind of the ambition and culture that we wanted to build. Again, I think culture is a strategic question, which means there's not really a right answer, right? You have to choose one that works for you. But we were all in. Like, we ran it like a startup. It was highly iterative, chaotic, but 100 hours a week, everyone obsessed with it. Everyone's social life completely merged with business. And we were super transparent, to a sort of alarming degree, and also focused on specialization within the team, as opposed to, having a bunch of people who are all supposed to be, good at every aspect of venture, right? We ran it like a company where some people were going to be world-class at sourcing, some people were going to be world-class at diligence, some people were going to be world-class at helping portfolio companies, some people were world-class at making the intellectual decision about, is this an investment or not? And because that was relatively radical relative to sort of the incumbent venture capital mindset. And so there was a lot of inherent conflict in that, because we didn't think about deals as belonging to an individual partner or not. We thought about them as being, the team working on something, right? Like you might tackle a product build or something. And so, the culture, the incentive structures, all that stuff was not necessarily, it wasn't what we wanted. We were pulling in a direction that other folks maybe didn't want as much. And so, ultimately it just became pretty clear we needed to kind of separate out. And I'd say, I give everyone credit for this. I mean, I give Joe, Brian, and Jim all credit for this, because most venture funds wouldn't have done that. Most venture funds that had a successful first fund, got their second fund raised, we had $448 million first fund, $500 million second fund. That was a lot of money back in 2012, 2014. Most people would have just kept going for 10 or 15 years and slowly grown to hate each other. Because it's a huge deal to break apart a firm that's done that, right? And so you give them a ton of credit, having the courage to do it, all of them. I also give our limited partners a huge amount of credit, right? They were able to see that this was ultimately what was going to be best for them, but not just like fall back on heuristics, like, okay, like you never back a partnership that breaks up. Or not. Some of them said, hey, listen, we're going to take a fund off and see how it goes. I totally get that. But I'd say 95% of the limited partner base was unbelievably constructive as it relates to that. And so we were really lucky to have that. It's not, I don't take it for granted even to this day that we were given that opportunity. And it allowed us to learn a lot about what we didn't want to build and what we did want to build, and then apply it immediately when we kind of refactored to 8VC.
I mean, you guys are as much entrepreneurs as you are investors. I think people know this, and I said it in the introduction, but you co-founded Affinity and Resilience. I mean, two companies alone that would merit a successful career. But you're one of the few firms that has had success with the incubation model and being able to launch these companies out of a venture firm. Many have tried, most fail, most don't do it well. What sets you guys apart? Like, why are you able to orchestrate this model in a way where you're able to find success? And would be curious to hear how it's so integral to 8VC, and then again, what sets your approach apart with that model?
Yeah, well, I mean, I think, listen, it's been highly iterative. So I think the first part is like, I will give Joe a huge amount of credit for his overall strength in iteration. And that sounds like a funny thing, but it's unbelievable. I mean, the pain tolerance that he has, for iterating ideas, late into the night on a Sunday on nuanced little things, right? Like what exactly the, EIR model should look like for the next, whatever. Like it's incredible. And I think that is like, Joe is incredibly smart. Everyone knows he's super smart. He's chess champion, blah, 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 all this stuff. I mean, that's great. But I know a lot of smart people. It's unbelievable his tolerance for pain. And I mean that not in like a bad way, but just a lot of people are willing to tolerate pain when they're in their 20s and they're broke and they want to be successful, right? But he has the same, if not more, pain tolerance today than he did when I first met him, at least. And it's really remarkable. And that inspires, I think, our organization. Listen, it also means that we embrace chaos, because if you just iterate stuff constantly, like there's a lot of false starts. And I think that can be frustrating. There's definitely people in our organization, in the world, who maybe are better at like setting an initial plan than me and Joe would, because our strategy, like we fall back to iteration. But I think that's like, iteration is something I definitely look for in founders. And I think that's what's been, that's enabled us to build a build program, almost like an internal company, right? That has been, I think, relatively successful. The other thing is we had evidence before we really launched it. So, there are 5 or 6 companies that we think were basically the evidence that we used to justify build. Affinity is one you mentioned. Qualia is another one where, Nate Baker was an intern with me and Joe. He was an associate for us. And then all he could ever talk about was title insurance. And then he, basically went and built a title insurance software company, which is now like, 30+% of the market. And there's other examples. Maria was Joe's chief of staff at Kojo. Anthony Goen was Joe's chief of staff, started Hearth. And so there were people leaving and starting companies or sort of incubating them inside of Formation 8, but there was no mechanism to invest in them. Like with Affinity, we couldn't even invest in Affinity from Formation 8 because it was like considered a conflict. So we had to like raise an SPV for it or raise money from other people for it. So there was all these like early chaos. And then obviously there was Joe's track record with Palantir, Anapar, and OpenGov and other businesses. So when we got 8VC set up, we said, where do we want to grow this from? And, we looked at all the same thing people look at. Should we do a big growth fund? Should we do a hedge fund? Should we do a credit fund? Whatever. And we thought, well, like, it seems like we're really good at this, at like creating, like attracting talent, harnessing it, helping people start companies. Like we're not running them, but we're helping them overcome inertia. Right? We're helping them with that early iteration. And we've seen that the other thing is like, it just gave us energy. It was like, it created passion, and it connected us to the team that was starting to grow, right? It's not just like me and Joe and Alex and Jake and Kimmy sitting around anymore. Now we had like other people we had to keep motivated and excited. And so we iterated in a relatively, I think, conservative way based off data to this idea of launching Build. And then when we did it, we did it big. We figured out the incentive structure that was correct, because we knew that we needed to be able to basically incentivize our whole team with equity directly in these companies if we wanted to really proliferate. And that's rare, because a lot of firms that I think they maybe own a lot through their fund, but they don't actually incentivize their young people, who in many cases are doing a lot of the work. And while the partners at the firm are incentivized through the carry, no individual deal really will move the needle, on, even if someone has millions of dollars of work, just if you kind of look at the way that the math works out. So we needed to be able to set that incentive. And then the last thing was figuring out how much we could credibly take to and still attract world-class talent. And that, again, was an iterative thing. And we made some mistakes. We owned too much, made some mistakes, probably didn't own enough, but we kind of settled on a place where we can get very strong founders who maybe started, multi-$100 million companies or ran big public companies to actually come join us, because we look like a junior co-founder on the cap table. So it's not nothing, but it's not like we're trying to take 50, 60, 70% or something. And then we also, we'll finance these businesses to de-risk them a bit. And so overall, we think founders get made, they probably break even or actually get ahead based off the dilution we prevent on subsequent rounds. So it's been a huge, and then the last thing I'll say is we've worked a ton on iterating to how do you balance the tension between a build organization and an investing organization? Because even though build is awesome, super passionate, whatever, it's only 25% of what we do. The other 75% is investing in companies. So how do you balance the staffing? How do you balance the attention, the cultural value of those things? And again, it's a constant iteration, but it's one that we really leaned into, really, I think Joe's sort of vision for what it could be. And we feel really happy and fortunate that we focused on that over the last 4 years or so, versus chasing stuff that maybe we would have been just a commodity provider in the market.
Yeah. I have so many follow-up questions to that. I mean, you talked about some of the learning lessons. I'm sure everyone's curious how it actually works. Like, are you incubating the ideas and going out and finding the entrepreneurs, or do you have junior staff internally that have ideas and they promote it up to the more senior leaders of the firm and say, hey, I have this idea and I want to launch it under 8VC? Or is it a combination of both? I'd be curious to walk through like how this happens from the inception of the idea to the actual, this is the staff that we're going to run with, and here's their incentive structure to maximize the probability of success.
Yeah, it's a great question. And there is not one answer, although there are probably 2 or 3 distinct answers. So the first thing I'd say is like, we operate at 8VC with like a one team, one dream model. And that applies on the investing side and it applies on the build side. So the ideation happens mostly via the investing team, the same way that we would talk about themes in a space or whatever. I'm sure most venture funds have some forum with which they talk about where the world is going, not about specific deals, but more thematically. So at 8VC, we obviously do that too. We can manifest those views both through finding investments, but we can also manifest them through building companies. So it gives us this other sort of vehicle to harness the intellectual capital of our firm. It also gives us another vehicle to harness the human capital of our firm, because like at a lot of firms, the young people maybe want to be entrepreneurs that are working there. At 8VC, you can have an entrepreneurial journey. In fact, you can have multiple entrepreneurial journeys without leaving. You can still leave, right? Because there's an ability to both have that journey and have, significant economics in that company and stay. If you think maybe you actually aren't the best CEO or COO or whatever, maybe you recruit your friend to do it and you go on the board and you're super involved, but you stay. Because maybe your skill set actually is not being a CEO. Maybe it's actually in helping overcome the inertia. So while we don't necessarily want to block anyone from, any of our principals or associates or even partners from going to start and run a company, we do want there to be a real sort of alternative to doing that, because in many cases, there is a better person to be the actual full-time CEO. And so the ideas largely originate from the investing side and or from other things we observe in the market. It's not always the case, though. Sometimes people, especially technical folks, will bring us an area. Maybe it's a technical area, or maybe it's even a sort of rough sketch of a business, and say, hey, like, I want to start this with you all. I need help building the company, bringing all the unfair advantage to that business so that it can launch much faster. Maybe can you help me find a CEO for this? I want to be the CTO of it. And so in those cases, maybe they brought more of an idea. We also have EIRs that are always in 8VC. And again, some of those folks will start with as broad we'll find them. They're really good at product engineering. They come in and they say, I want to do something in healthcare or logistics. And we're like, this is a real example, by the way. A company called Oetting was started this way, and Andrew and Nate came, and we were really great product and engineering people we knew through. They've been in another portfolio company. Their CEO had referred them to us, and they started with that broad a thesis, and we spent months narrowing down, going through all of the different parts of healthcare, and then being like, I don't know, and then my partner Jake Medwell, who runs our logistics investing, took them through logistics, and they were like, okay, this is for us. They started Baton, they built it up, just sold it to Ryder, and now they're the CTOs of Ryder, which is one of the largest logistics companies in the United States. And that was like literally from, okay, we'll take 30% of GDP and start there. Others start much more targeted, where an EIR comes in. We just launched a company called Saronic, which is a sort of a next-gen maritime defense company. And Dino, the CEO and co-founder, he had been a Navy SEAL for a long time. Then he'd been at Vista Equity in Austin, and so we got to know him. He really wanted to start a company. He came in with like 3 or 4 different defense tech guys. He knew he was going to do defense, obviously, is where his unfair advantage was. He had 2 or 3 sort of high-level ideas that he had some insight were going to be important, and then we ran those through. Simon and Saronic launched it. So EIRs sometimes come in with, a varying set of ideas, roughness, and then we just kind of run them through a process to harden it up. And so the EIR ideas, I'd say, are a little bit more externally motivated, but many of the ideas come from the investing team. And then what we do is we harden the idea, and then we recruit aggressively against it.
How does the decision-making work to greenlight an incubation versus greenlighting an investment? Is it similar people, similar stakeholders involved, or what are the discrepancies between the two internally?
It's a great question. The build does not exist inside of the investing process. And what I mean by that is, as anyone in venture knows, a well-oiled investing team has some structure as it relates to deal comes in, deal staffed, deals run through diligence, deals decided on, moved on, right? I mean, if you're processing thousands of deals a year, which most legit firms are, you got to do that. You especially got to do that also because you want to be competitive in the market. You got to move fast. So there is a bit of a formulaic approach to managing a investing pipeline. We don't manage a build pipeline in that way. There are many ideas that exist in sort of various degrees of limbo that may get worked on when someone finds them interesting. They may get worked on when, maybe an EIR comes in and we run them through some ideas. But then there's also ideas that just like speed up and move fast. And to some extent, the signal that we use about the seriousness of an idea is like the natural pull or lack of pull that it experiences. We can always get better at making that process purely meritocratic, right? That's what we're always driving to do, as opposed to just the person who's the loudest or the person or Joe likes the idea or, and sometimes that actually causes the other thing. And people say, they're going to try to poke holes in it. Like, it's this like very much like sort of town square type approach to vetting these ideas. And where it enters into the investing realm is when it's becoming a deal, right? When it's going to be a company almost certainly, and we're deciding, is this a company that we are going to fund or not? We don't like having folks who come to an idea that with us that we don't like. It has happened, but we try to not have that happen. We want to fund people that have been working on these ideas when it's an EIR situation. Obviously, if it's not, and it's us ideating through an idea, then we just won't sort of staff the recruiting part of it. But it's a dance because we want to vet the idea with the talent market. It's one of the most important things. So I want to go recruit a potential founder or, advisor, or even just talk to other potential investors or partners on the company. And at the same time, I have to be sort of keeping the broader investing team aware that I'm creating seriousness around that deal. And then obviously the terms and everything like that look a lot more like a traditional investing process, but the coordination is more of a dance than it is, a sort of mechanistic process. And it's a great question because you want the rigor of the deal team approach looking at an idea, but you also need to be able to have the sort of creative exuberance when you're launching a company, especially if you want to recruit. All right. No one wants to hear like all the reasons why something's not going to work. If you're trying to convince someone to leave their, cushy job and come work, on a startup. So a lot of that comes through. It's a lot of the reason that we don't think it scales. Like we don't think we could do like 50 build companies a year because so much of it is the sort of relatively inefficient intellectual exchange between the investing organization and then the subset of the investing organization that's working on that particular build. And so it's one of the reasons why we always have a senior partner or someone or frankly, someone who's proving themselves to be a partner at the firm who is running point on a build. It's never like, okay, yeah, like just, some associates work on it in the corner. We've tried that. It just doesn't work because someone has to be making noise that this thing is either good or bad. And the reality is a lot of people who haven't been at 8VC as long may not feel comfortable doing that, or, worse, the organizational problem is that they're not being listened to. And so we make sure as part of Build that there's some partner who understands that dance, who is point on it. And that's the only way you can kind of do it.
Interesting. I wasn't intending on asking this, but this question has come to mind as I'm hearing you talk through the Build model. How does your recruiting differ for 8VC versus that of a traditional venture firm? Well, if at all, maybe it doesn't, but I'm curious because it is so operationally oriented. It feels like half founder, half investor, not just with yourselves as the partnership, but also the junior folks. Like you're trying to empower them. You're getting them hopefully ramped up to run point on some of these build deals. And I'm sure if you're trying to scale that, even though it's inherently unscalable, like you're talking about, you have to have the people beneath you that you have trust in their operational ability. So I'm curious if there's anything different that you guys are trying to tease out when you're hiring an investor or junior person.
Yeah, I think the biggest thing we're looking for is the right entrepreneurial energy, because I think there are, while operational like skill and interest is a part of the sort of launch motion at Build, it's more about entrepreneurial and creative energy, because after 6 months, 12 months, whatever, the best Build companies have fully replaced anyone at 8VC as it relates to an operational or day-to-day function beyond like the things that a normal investor might be engaged on. Now, we may be more involved, right? Like we might be doing 2 or 3 times a week, BD type sessions or strategic sessions if that's what they want, or recruiting, we might be interviewing every founding engineer, right? Or probably there's me not interviewing them, but just like trying to convince them to come join. And maybe with a normal Series A company, they might only ask us to do that a fraction of the time or something. But it's that handoff period, that 6 to 12 months where you are between an operator and an investor and entrepreneur. And I would think about the way I think about it is it's an energy thing. It's like you want people who are excited about the idea of like, oh yeah, we got to put together like some vaporware because, maybe this company will like join as a design partner. So let's like do it all weekend, and that people are excited by that. And some people aren't excited by that. And in fact, some really good investors are not excited by that. Like some of my friends who, either great venture capitalists or maybe they're great public markets investors or private investors are like, have no interest in like iterating on some like pipe dream, they want to like focus on doing deals. So because there is a cost to spending your time in that way, if you think about it on a purely rational basis. So you need people who it gives energy to. And that's the biggest thing we look for. Most of our folks have joined us either right out of undergrad or out of grad school, or they've joined us from an operating role. But a few have joined from banking or hedge funds or whatever. What we're looking for is that entrepreneurial energy. Are they going to be excited? Are they excited and feel like, oh my gosh, this is incredible. The fact I get to do investing and help launch companies. And the other thing is like, even just respect for that. Even if they never really want to do that, or maybe they only want to do it once a decade, that's totally okay. The investing business at 8VC is very important. And we need people who are focused on that. We need people who respect the built part of them and don't resent it or view it as a waste of time. Or, when they hear about me running into dead ends for 2 years trying to do some project, right? And they don't think, what the is he doing, right? Like, I want to be like cheering from the maybe they're telling me I'm stupid. That's okay. Like the feedback, but there's no resent about it. It's like, maybe they're like, hey, Drew, you've been trying to like convince Optima to build a company with you for, a year and a half and you keep flying to Minnesota. Maybe it's not going to happen, right? That's good feedback. That's true, by the way, although I still want to build a company with them. But like the respect for the process is like basically, I think, ubiquitous at 8VC. And it permeates everything. It doesn't just permeate the investing, it permeates the finance department, the legal department, the ops group. All the EAs understand what build is, understand how it's different. Like, it really is like a foundational pillar of that. So that's probably the only thing that we look for that's a little different. Usually if we want a specific technical skill set, we will bring that in more through like an EIR, or the other thing we do is bring in like exec in residences who have a domain expertise or a technical expertise that is related to a build area. And even then, like even better is to bring them into the specific company, because now you're resourcing the company and it's also a harder sell. So again, it validates the idea.
Mm-hmm. One of the things that I respect about what you guys do is you're building technologies that are actually driving society forward, whether it's life sciences, some of these other deeper tech areas that most VCs typically avoid for a variety of reasons. But it's reminiscent as of late to an article or a letter that Hemant Taneja wrote to his LPs. I don't know if you read the letter, but if not, essentially it's about how venture as a whole has been doing society a disservice, and that few dollars are back in the technologies that are going to solve the real problems that we're currently facing in society today. And I'm curious from your perspective, if we've reached a point of incrementalism in tech, and if you attribute this to venture, and how you think through our role as venture capitalists to back technology that's truly going to benefit society.
Yeah, I mean, I think Hemant is amazing, by the way. My next comment is not to say that I think he's wrong. It's that I think venture capital is both a bit high on itself and also a bit overly critical, and they're sort of related in this way, which is like venture capital, regardless of whether you're funding like some random app or you're funding like defense tech, or you're defending, next gen energy, or whatever, you're funding someone's dream, right? And so American society is built on the idea that you can dream, and that the idea that if you work really hard and you, to some extent, convince other people that you're able to sort of gather resources, that you can achieve your dream, and that by you achieving your dream, other people achieve their dream. That's really the hack of, because the rest of the world, that's not necessarily the case to varying degrees. It's that dreamer mentality and taking the dream and making it real, and society celebrating that, has driven this unprecedented prosperity. And so whether you're funding relatively trivial dreams on a sort of a societal or, humanity scale, or whether you're funding higher level dreams like deep tech or rockets or stuff like that, you're still funding individual dreams. And those are still unbelievably important for the people who work there and the people who have that dream. So whether it's your calling to back these, more trivial things, I don't mean trivial in a bad way. I just mean that they're not like at societal level importance, or you want to focus on those problems. I think we should take solace in the idea that by and large, venture capital is highly aligned with what I think at least is the most powerful concept that we've really seen in the last, since the founding of America, which is this idea that you can dream, and that you can achieve it. And even if you can't achieve it, you have the opportunity to achieve it. I also think that VCs have now occupied a much larger part of sort of the social conversation, despite us being still a tiny, tiny, tiny fraction of the amount of capital deployed on this stuff. So we have focused a lot on funding what people might sort of commonly view as being, these sort of higher order things, defense, biotechnology, systems for the government, systems for, large industries. And we couldn't do that if there weren't other people down the line who are willing to fund these more capital intensive projects. So, Hemant is building a asset management firm. Like him and a handful of others are building the next Blackstones. I think Hemant will do it. He's an incredible entrepreneur as it relates to building an asset management business. I learned a ton from talking to him and the way he thinks. I have huge respect for him. So he may be able to take some of these projects and fund them through the life cycle. But the only way to do that is to have a credit fund, to have maybe a private equity fund, to have a hedge fund, to have a huge growth fund, to have these things, right? So is he a venture capitalist anymore? I think he thinks like a venture capitalist. I think the first principles that he has come from venture and from sort of entrepreneurialism. But the firm he's building in order to have a chance at maybe funding the full life cycle of some of these really capital intensive big projects looks more like a sort of a multi-strategy firm. And so I think if you're a Series A venture capital investor, the idea that you are going to only fund massively capital intensive projects, but you're going to not have any partnerships or strategy or really knowledge of the way that private equity and, credit and infrastructure financing and stuff works is kind of a pipe dream. So what I'd say is, in general, I think venture capital is great for society. Even if it doesn't generate returns, it's good for society, honestly. But it's even better because it does, when done well, generate great returns for people. And then I think these big projects are going to require venture capitalists who either have a much larger aperture of what they're willing to sort of do, or partner with other firms who know how to finance companies for real scale, because they are very capital intensive.
Yeah. I mean, you touched on something that I think is also interesting and something we've noticed, which is there's this crossover between venture capital and private equity today. The two almost seem to be blending together to some extent, at least in the financing some businesses out there. I'm curious, as you think about the evolution of venture in this asset class, I mean, you talked about General Catalyst being the next Blackstone. Where do you think venture's headed? Do you think there is this emerging gray area between venture and private equity that is going to be more predominant 5-10 years from now than it is today?
Yeah, I mean, I think that basically there's been two big iterations of scale capital within venture capital, right? First was SoftBank. SoftBank took the approach of okay, we're going to king make in a few industries, basically take these companies that are, somewhat undifferentiated, but have built big scale. And then we're going to give them enough capital that no one can compete. And a relatively complicated relationship with founders, right? Then you had Tiger and, a lot of the hedge funds, which realized they were, I think Tiger did an incredibly good job of making the capital formation process for startups easy. I don't think it could happen without Zoom, but they embraced the concept of early stage venture capital, which is this idea of catering to the founder And then they just like scaled it up dramatically and tried to obfuscate all the like complexity for the founder. You know, SoftBank would be like, oh, you need to come fly and see, you know, Masa in Japan. Oh, wait, he's not in Japan. He's in South Korea. Okay, here, come here. Meet him in his golf simulator at 2 a.m. Okay, you know, 10 seconds of a meeting. And okay, here's, you know, like this crazy dance, which maybe was good because it actually made it hard to raise lots of money. But I don't think it was like, I don't think it was all that substantive. Tiger did the exact opposite, right? It's like, you know, Scott Schleifer is like the hardest working guy I've ever seen, takes Zoom calls like all day, every day, meeting with Series A founders. And so they really changed the paradigm. I think both were very focused on accelerating sort of companies that have already gotten to scale. And I think that was a little bit of the issue. Is like there's only so many companies that get to scale and build a machine that can just ingest cash, and that's the only problem. Most of these companies have other issues, and some of it is just ability to get to scale, like takes time. This is where I think private equity and venture capital will have the sort of the third sort of wave of scaled venture capital, where people will say, okay, like what we did with Resilience, wanted to get a biomanufacturing company off the ground fast. Started it in, you know, sort of April, May of 2020. We wanted to get it fast because we wanted to take advantage of a lot of the temporary sort of tailwinds that were there. And if you want to do biomanufacturing, you need biomanufacturing facilities. So you got two choices. You can either build them from scratch, it takes a long time and is very expensive, or you can acquire them. And so we decided to acquire them. And so we started Resilience like a pretty traditional, you know, a little bit larger scale build, but the immediate action afterwards was to find facilities to purchase so that we could have a network that actually could produce revenue and deal with customers immediately, and then iterate on top of an existing infrastructure. That is what I think will probably be the next wave of scaled, you know, venture capital, is partnering innovative entrepreneurial people who have a true like risk-taking mindset, a long-term capital structure, and then marrying it with the sophisticated M&A capabilities of private equity, where there are a lot of assets in the world right now which could be a lot more valuable if they were part of a broader vision or ambition. And so at least that's where we think we're starting to see some opportunities, and it may be wrong, but we're exploring it.
Drew, if we could feature anyone on the show, who should we interview and what topic would you like to hear them speak about?
I think that if you want to hear about true early stage venture capital from a truly independent source, I always think Charlie Songhurst is one of the sort of most interesting and insightful angel and really angel investors. Been investing his own capital for a long time. He's got one of the most sort of, I think, validated data sets that proves that he knows what he's doing in kind of a incredibly top tier way across all different types of companies. And I think he's a voice which is probably underheard and listened to, at least from a public perspective, but privately, he's one of the most respected angel investors in the world.
Do you think remote work is here to stay?
I think remote work is a total scam. I think basically remote work makes it super easy to say that you met your hiring goals, and that, you know, you have this big team, and it's like the most 2021 type of thing ever. I think it's by exception that you get all the benefits that people talk about. Like Envision has been remote only for a long time. They like probably know how to run a remote company. I bet it's really hard. I bet they have like lots of internal metrics and processes and like think a lot about that. If your company was remote first or remote only because there was a pandemic and you grew like with hundreds of people, I think as you're a founder, you got to ask yourself, like, do I have any fucking idea what I'm doing? Or did I just have to do this because there was a pandemic and now I don't have to do it? And you need to really think about whether you've built a company that is fundamentally designed to operate remote or not. Because I just don't see I don't see metrics. I don't see systems. I don't see anything that would suggest, you know, other than by exception, that folks actually know what's going on with their remote-only companies.
Will you invest in a remote-only company?
Let's put it this way. If you want to build a remote company now, and you want to do it from the beginning, remote-only, I actually don't mind that as much. Because again, I think you can build the company with remote being the talent model that you have. And I think a smart founder would then build systems around it. I think if you're just accidentally remote because you hired people all over the place, you don't know where everyone lives, whatever, I think either you need to like take a private equity approach to your own business and imagine like, okay, Vista just bought me. Are they going to run this business like I'm running it today? Or are they going to like institute a lot of changes? And so I think it's less around like people who are starting business from scratch today, who maybe actually learned a bunch about how remote work works, and more about companies that scale via remote. And that's where I think, people need to really take advantage of the fact that 2023 is like, you can be a lot more prescriptive with, your talent and say, okay, we want to stay remote. People want to stay remote. In exchange for that, you got to do X, Y, Z, right? We're going to institute performance-based systems. We're going to do something and actually enforce it. Because I think if you're not doing that, there's so many examples of, and I've read these Reddit forums about people who work like multiple jobs. It's crazy. Like engineers working like 4 or 5 jobs. Yeah. Like, okay, listen, good for them, by the way. Like I respect the hustle. I'm not necessarily criticizing them for it, but I'm criticizing the performance management system that enables someone to make $300,000 a year at 5 different jobs. Like clearly you couldn't do that if you were working in person. So there's something that has to give. And I think it is right now, but a lot of it is around performance management. And if I don't see processes that align with remote work, then I'm just skeptical.
Yeah. Well, there's something also to be said for just building camaraderie of being in person and having serendipitous conversations around the engineering problem that's coming up, or the last call that you just had with a customer where you weren't sure to handle this rebuttal. And not everything should require a 30-minute Zoom conversation to talk about important topics, right? So I think a lot of that gets missed. It'll be interesting over time to see benchmark data performance between remote-only companies and those that have significant in-person presence. So we'll see. But I do agree. Drew, what do you know that you need to get better at?
Oh, man, tons of stuff. I think I constantly need to get better at time management. I mean, it's the most important thing in the world because it's the scarcest resource and it's probably the least analyzed thing. It's especially the least analyzed kind of as your time becomes more your own to manage. I think most people think about it less. And as as sort of the way you invest your time, hopefully has more opportunity cost to it. I think you naturally think about it less because, you assume you're good at it, or you assume that, that you have a natural inclination to it, or you just sort of say, well, I'm just going to do it this way because I'm in charge or whatever. And that's what I think about the most is like how to better manage my time, how to better get input on the way I'm managing it. Another thing that I really respect about Joe is that he, still asks for like feedback on his calendar for me every week. And he's very open to the organization about like, where should I spend my time? How should I do things differently? And that's something I think just lifelong I need to get better at.
Yeah. And Drew, last, what is the best way for listeners to connect with you?
Best way to connect with me, I guess, would be send me an email, drew@8VC.com. I don't have big social media presence. I think I have a Twitter, which maybe has like 100 followers. They can find me there if they want. And if there are people who are interested in anything about 8VC, we built out a great website. I think it's great, at least. It has a lot of content on it that I know is great. Our head of design, Luke Bugby, who's amazing, has built out. So if there's questions about the concepts or the theses or anything like that, I'd encourage people to check that out.
Awesome. Well, it's always great talking to a fellow Iowan.
Thanks so much for having me.
That will wrap up today's episode. Thanks for joining us here on the show. As always, show notes and links for the interview are at fullratchet.net. And until next time, remember to over-prepare, choose carefully, and invest confidently. Thanks for joining us.